Welcome to the final panel of the day. This one's on consumer regulations. I am Amy Henderson, the Assistant Director who oversees the consumer laws and regulations function here at the board. We have 5 panelists here, 3 in person and 2 are virtual. They are Kevin Hill from the National Community Reinvestment Coalition, Mickey Marshall from the Independent Community Bankers of America, Horatio Mendez from the Woodstock Institute, and I think on the line we were meant to have Victoria Hosendorf from the Enterprise Center, and Keith Thornberg from the Missouri Bankers Association. The format of this session is that each panelist will have the floor for 5 minutes to make remarks. Richard has already explained the time card system. We want to use the time cards to keep the timing on track because we want to ensure everyone on the panel has equal opportunity to express their views in the time that we have. After each panelist has spoken, we will likely have time for a little more exchange and follow-up questions before our panel concludes at 4:50. Given the nature of the review, I'm here in order to facilitate the discussion, and I'm in listening mode to hear your input. We really appreciate your attendance and participation today as part of this important EGRPRA review for this panel of the consumer regulations that are in scope for the EGRPRA agencies. Thank you. And I will now recognize Kevin.
Thanks, Amy. Hello, everybody. Kevin Hill, Senior Policy Advisor at the National Community Reinvestment Coalition, or NCRC. If you're not familiar, NCRC is a network of more than 700 community-based organizations dedicated to creating a nation where all Americans can build wealth and attain a high quality of life. The Community Investment Act is a crucial part of NCRC's work, and the many partnerships it fosters between banks and community development practitioners bring billions of dollars into neighborhoods every year. Changes to CRA requirements, such as raising the small bank threshold to exclude more banks from the community development test, will hurt neighborhoods. All intermediate small banks combined today average about $3 billion a year in community development financing, which is right around the size of the community development block grant budget. If the regulators choose to raise the small bank asset threshold, this will result in less private capital for needed community development projects that bring job opportunities, increase the supply and quality of affordable rental housing, finance medical facilities in lower income or rural areas, just to name a few examples of CRA activity that takes place around the country. With less private capital from banks, communities that need these resources will either have to make do with less, or federal, state, and local governments will be forced to shoulder more of the financing. Either way, lowering CRA requirements means communities and taxpayers will suffer, and that burden will only increase the higher the small bank asset thresholds are raised. The agencies have also asked whether changes in the financial services industry have resulted in any CRA regulations becoming outdated. There is no clearer example than the branch-based approach to defining a bank's assessment areas. The American Bankers Association's EGRPRA comment put this plainly when it stated that banks have evolved beyond the traditional branch-based model. NCRC's analysis backs up this claim. We've identified that over a quarter of bank-originated mortgage and small business loans were made outside of counties where banks maintain branches for each year from 2021 to 2023. Restricting analysis to only markets where a bank maintains branches limits the Community Reinvestment Act's ability to evaluate if banks are meeting credit needs and preserves unequal access, as banks can simply refuse to open or maintain branches in markets where they actively lend in order to avoid a Community Reinvestment Act review. This outdated approach also provides no incentive for banks to serve credit needs of communities with minimal branch networks, which are often the most underserved. For example, majority Native American counties have an average of 2 bank branches compared to the 9 branch average in rural counties and well below the 27 branch average for all counties. According to the agencies, access to banking and credit continues to be a chronic barrier for tribal economic inclusion. Failing to account for modern banking practices maintains this lack of lending and bank services in Native American and similarly situated communities by depriving banks from receiving positive consideration for serving the credit needs of these largely branchless markets. The best way for the agencies to address this and bring CRA into the 21st century would be to reverse your plan to repeal the 2023 CRA rules. The agencies have also asked about opportunities for clarification. The agencies should explain when banks can receive CRA credit outside of their assessment areas. The lack of clarity on this issue puts an additional burden on majority Native American counties and rural counties that have fewer bank branches and the organizations that serve these markets. In addition, uncertainty around staff levels and funding at the CDFI fund during last year's government shutdown are very likely to have led to delays in the annual CDFI certification process. New York's regulatory agency has issued guidance detailing simple documentation that CDFIs can provide for financial institutions to continue to receive consideration for CDFI financing under New York State CRA law despite delays in certification. The agency should quickly issue similar guidance at the federal level to assure all stakeholders that CDFI financing will still qualify for CRA credit. Failure to clarify this will force banks to take unnecessary steps to document community development purposes of CDFI activities, and most importantly, could result in a loss of capital for CDFIs that have been recognized as CRA-eligible intermediaries since the 95 regulations were adopted because of their positive impact on local economies. The last issue I want to raise in my opening statement relates to strategic plans. The 2023 rules introduced common sense updates to how banks solicit public input on whether their strategic plans serve community needs by placing draft plans online. We're using online technology today for two of the panelists in this panel. The agencies noted the importance of constructive community involvement in the plan process when the 95 rules were finalized, and pulling down this necessary update from the 2023 rule will undoubtedly result in less input from the public. Furthermore, placing strategic plans online could also reduce bank expenses related to purchasing notices in newspapers and providing copies at all branches covered in the plan. More detail is provided in NCRC's written comments submitted last year. Just in closing, the agency should take no actions to weaken CRA regulations, such as raising asset thresholds, given the CRA's many benefits and low compliance costs compared to total non-interest expenses. The long-term prospects for an economy that truly provides everyone with a fair shot to succeed is very much tied to the continued strength and relevancy of the CRA, and we simply cannot afford for the CRA to be rolled back. Thank you.
Thank you, Kevin. Next up is Mickey Marshall.
Hi, good afternoon, everyone. My name is Mickey Marshall. I'm a Vice President and Regulatory Counsel at the Independent Community Bankers of America. I think, to no one's surprise, the banking industry guy is going to disagree with a lot of what the NCRC guy just said in his remarks. So I think, if we think about what the origins and purpose of CRA were, it's an anti-redlining law. It's designed to prevent banks from taking deposits in underserved areas, low and moderate income areas, and not making a commensurate reinvestment in those areas, not reinvesting in their local communities. In our point of view, that is what community banks do. Community banks are not in the business of siphoning deposits from rural areas or from underserved urban areas and then lending them out in more affluent areas. Their business is entirely based around their local community and helping small businesses, helping small farms, and helping the residents of those communities thrive economically. If a community bank's community isn't economically thriving, the bank itself isn't viable. And so because of this, because our business model, I think, so closely overlaps with what the purpose of CRA is, we think it makes sense for there to be a more reasonable and less burdensome CRA evaluation framework for small banks specifically. So I think the trade-off that you have to think about here is for every marginal dollar that is spent on CRA compliance, whether that's additional staff, whether that's technology systems, those are dollars that can't then go, be put back out in terms of loans to the community, in terms of local reinvestment. And so that trade-off between increased compliance actually does result in a diminishment of what the purpose of the act is, which is trying to get money into these low and moderate income areas. So for those reasons, we think we are strongly supportive of the agency's rolling back of the 2023 CRA rule. That rulemaking process really was the first thing I started working on when I started working at ICBA, and that was 7 years ago. So it has been quite an odyssey to go through that rulemaking. And I think what we've learned is, though the existing rule isn't perfect, it could be made a lot worse. It could be made, at the very least, a lot more complex. And we think that that complexity wasn't justified by additional clarity in terms of how CRA ratings were established, and wasn't justified by actually a higher level of reinvestment in the community or more transparency into how the community is served. So though the 1995 framework isn't perfect, it is adequate. It does provide an adequate picture of community banks' level of commitment to their communities. And so going to a framework that more closely resembles that 1995 framework, maybe with some slight changes, we think is more appropriate than a comprehensive new rulemaking like was attempted with the 2023 rule. Some of those changes that we advocated in our comment letter in response to this EGRPRA process were higher asset thresholds. We think that makes sense as consolidation in the banking industry continues. We think that the current rules where you have a bank that's, $1.7 billion considered in the same category as JP Morgan as a large bank kind of defies logic for us. But we support other changes as well that have been mentioned in previous panels, including a qualifying activities pre-approval process, a qualifying activities list, perhaps some clarity in terms of how community development activities outside of assessment areas can be counted. But these things should all be around the margins rather than an entirely comprehensive overhaul of the rule. Thank you.
Next, recognize Horatio.
One Mississippi. Okay, there we go. Good afternoon, and thank you for having me back to participate in the spring break edition of EGRPRA Gone Wild. I'm the president and CEO of the Woodstock Institute. We're a 53-year-old Chicago-based research and policy nonprofit focused on consumer financial protection. In the Kansas City episode last year, we spent a minute asking whether or not EGRPRA has been subjected to its own EGRPRA analysis. I'm assuming not, but I'm going to put it out there again anyway. We also asked to reduce regulatory burden by taking a pause in creating so much regulatory instability. This whole debanking thing created a BSA KYC fire drill, which has not been without its own regulatory burden. Saying that reputation risk or disparate impact isn't a thing until it is again isn't really helping anybody. And adding additional citizenship requirements on SBA loans is drying up small business lending in communities around the country, which can't be a good thing for our economy, nor is forcing people to find their birth certificate or to get a passport to open a checking account. So please stop. I have the Fed here as a captive audience, but this also goes for your FFIEC cousins as well. So on to the DC edition. We have 4 suggestions. I'll start off with the 2 that are relatively low-hanging fruit. First, it's come to my attention that the Fed still hasn't aligned its Public Welfare Investment Authority under Reg H with the CRA. The OCC and the FDIC have taken care of this, so I don't think it's an insurmountable hurdle for the Fed to eliminate the need for state member banks to get prior approval from the board to make a public welfare investment that also qualifies under the CRA. Secondly, the 3 most triggering words for CRA officers are internal regulatory guidance. This guidance, which usually flares up at the worst possible time during an exam, is rarely if ever made public. This kind of reminds me of the conversations my wife has with her friends about how they talk with their husbands, they wish their husbands would do, but they never tell us. If internal regulatory guidance is discussed and being used by examiners, it's official policy, and it needs to be made public. Now on to the slightly more involved recommendations. So many criticisms of the CRA have to do with claims that covered institutions don't know how much is enough, and that exams are too subjective in what counts and what doesn't. For those that complain the most, the best way to shut them up is to tell them to create a strategic plan. But the current strategic plan process is woefully out of date when it comes to collecting community input on a draft plan. So here are some parameters that make sense to us. First, adopt the provisions from the 23 rule requiring that plans be placed on both the agency and the bank websites for a 60-day comment period. and require enhanced community input, like how community benefits agreements are currently negotiated. If the bank and the community agree, streamline the application. For the bank, this allows them to know exactly what's expected, how they're doing, and what's covered. For examiners, it's a streamlined process of validating bank data and progress and checking in with the community to make sure that their expectations are being met. Other recurring criticisms include inconsistency in knowing what's going to receive favorable consideration and what isn't. Our recommendation is to bring back 3 resources that had worked relatively well to help with clarity and consistency, but for some reason were abandoned. The first is an interagency version of the OCC's old Directory of Community Development Investments. Update it regularly on exam feedback and the evolution in community development finance, and then use it as training material for examiners and bankers. For those activities that don't fit cleanly into existing guidance, start writing interpretive letters again. Then get them out to the entire industry to ensure consistency and to save time and angst for everybody. Finally, another refrain is that exam teams from the same agency can take a completely different approach and find completely different outcomes from one exam to the next. So bring back the FFIEC Advanced CRA Examination Techniques training so that experienced examiners can train their peers in the field. Impose continuing education requirements so that their knowledge is constantly being refreshed as the industry and the regulation evolves, and it creates greater synergy among the different agencies as well. Now, many states have their own CRA laws, which we can talk about in a minute if you need to, including some that cover credit unions. As such, the NCUA and state-level regulators may be interested in the training as well, so the door should be left open for them. One last note, please coordinate with your respective CRA teams to ensure that any national discussion concerning the CRA does not conflict with regulatory conferences on CRA, as seems to be the case today. Thank you, and I look forward to answering any questions you may have.
Thank you, Horatio. And next, we'd like to recognize one of our panelists who's with us virtually, Victoria.
Good afternoon, everyone. My name is Victoria Hosendorf, and I'm speaking on behalf of the Enterprise Center, a nonprofit capital enabler with locations in Philadelphia and New Jersey. And today we want to talk about how do we push capital to places where it doesn't normally go. We have decades of experience working with low to moderate income small businesses throughout the United States, which has given us extensive insights into how the CRA can be improved to foster small business growth for all entrepreneurs. Across the country, we continue to see a troubling pattern in low to moderate income communities. Small businesses start with the same ambition and work ethics as businesses in prosperous communities, but they rarely reach the same scale, stability, or successful exits. The issue is not a lack of entrepreneurial drive. The issue is how our systems prepare these businesses to access capital. Today, many low to moderate income small businesses are asset light and liability heavy because they are geared primarily towards debt rather than capital investment. When a business begins its life with a capital stack built almost entirely on loans, it is much harder to reach scale, whether economic shock or achieve a successful exit. Modernizing the Community Reinvestment Act to encourage investments that strengthen business balance sheets, not just increase lending, but would help address this structural imbalance and allow capital to flow where it typically does not. In many low-wealth communities, the financial ecosystem is structured so that the entrepreneurs are introduced primarily to debt financing, whereas in more prosperous communities, they are more likely to encourage equity, invest a patient capital early in their journey. These differences at the starting line led to divergent outcomes, slower revenue growth, fewer job creations, and far fewer success exits for businesses in low to moderate income communities. The Community Reinvestment Act has been a powerful tool for expanding access to credit, but today we have an opportunity to build on that legacy by ensuring that the CRA also helps entrepreneurs prepare to fully participate in capital markets. First, the CRA should encourage investment in capital preparedness infrastructure. Organizations that help businesses build strong business and financial infrastructure through services such as business valuation, quality of earnings reporting, investor preparation, and due diligence support. Second, CRA should recognize and incentivize blended capital strategies that go beyond traditional lending, including patient capital, growth equity, and community investment funds that strengthen business balance sheets. In doing so, CRA evaluation could look not only at the volume of lending, but also at indicators of long-term business health, such as stronger balance sheets with positive retained earnings, revenue growth, wealth creation, exit strategies. And third, CRA should support capital intermediaries that connect entrepreneurs to multiple forms of capital and guide them along a pathway from startup to scale to mergers and acquisitions or even succession. At the Enterprise Center, we are advancing this model through our Center for Capital Investment, which is designed to help businesses build stronger balance sheets and the blended capital stacks that they need to grow and scale. The Community Reinvestment Act transformed access to capital to low to moderate income communities. The next chapter is to ensure that entrepreneurs in the community are fully prepared to participate in the capital markets. If CRA encourages institutions to invest not only in lending, but also into equity type capital to accelerate growth. Debt meets business conditions while equity accelerates growth. We need to push equity to low wealth entrepreneurs. Today, all we offer is debt, and it makes them hamsters on a wheel of debt. Thank you.
Thank you very much, Victoria. And finally, for these opening statements, I would like to pass the virtual mic to Keith.
Thank you. I have some additional topics to cover, but if I have time, I'll comment on the CRA. My name is Keith Thornberg, General Counsel of Missouri Bankers Association. I have been a state bank regulator, a bank regulatory attorney. Today, I'm more of a government advocacy attorney and a corporate attorney. My comments, first item is Regulation CC. Banks and customers are losing substantial amounts of money due to check fraud, and Regulation CC is a contributing factor. The Federal Reserve should ensure that the regulation does not restrict the ability of banks to protect customers and prevent losses. The MBA has previously provided a draft proposal to the Federal Reserve to amend Regulation C to insert a new section that would authorize 9-day check holds for suspected check or bank account fraud for the receiving bank, and also to allow an additional 9-day hold for the originating bank, and to establish revised check warranties for the receiving bank and their depositor to incentivize appropriate due diligence. Many times the bank is virtually certain that the check is not going to be paid because of suspected fraud, and the hold period may expire before the check is returned or the bank is able to confirm that the check is going to be returned. A bank is forced to either release the funds prior to having collected funds and risk financial loss to the bank or to the customer, or risk a Reg CC violation. Sending checks for collection is not a reasonable alternative due to the time and costs associated with that process, even if you can determine how to send it for collection. The entire regulation and commentary need to be updated to reflect the fact that there are no longer non-local checks. The definitions need to be updated and match definitions in Reg D. Regulation D, the definitions there are outdated and need to be revised and updated and matched to Reg CC. We need to consider eliminating now accounts, as they are irrelevant, given the authority today that banks have to pay interest on demand accounts that functionally operate in the same manner. Customers cannot distinguish a now account from an interest-bearing demand deposit account. Banks are cited for violations in offering and administering now accounts related to eligibility restrictions and the requirement that the bank must reserve the right to require a 7-day notice for a withdrawal or transfer. By aligning the regulatory requirements, confusion and arbitrary penalties can be avoided. The definition of automatic transfer service accounts likely no longer is necessary. Appraisal regulations. Recent presidential executive order instructs the agencies, banking agencies, to review appraisal regulations. This includes reducing unnecessary appraisal requirements for low-risk transactions. The thresholds should be increased to stipulate when a licensed or certified appraisal is required. The cost of outside appraisals has increased dramatically. This is a pass-through cost to consumers and to small businesses. There are many loans made by community banks where the bank is capable of evaluating the value of the property at a much lower cost to the borrower or applying alternative valuation models. Flood insurance. This regulation should be modernized and to remove the requirement for flood notice to be provided to the borrower on every notice or extension of an existing loan where flood insurance is in place. This is a redundant notice to tell the borrower each time that insurance is required. It's not necessary. Lenders are required to maintain the flood insurance and assure that it's in place throughout the life of the loan. CRA, Community Investment Act. Definitions and thresholds for bank sizes and reporting of certain loans should be updated, modernized. Consideration should be given to harmonizing these requirements with small business data. Reporting rule in Section 1071 of the Dodd-Frank Act. Commenting on the other comments on the CRA, this statute dates to 1977. The 2023 proposed amendments are not compliant with the law. It's almost a meaningless exercise to talk about CRA reform if you don't go to Congress to get the law changed. The comments about bringing equity and capital investments into this area. Well, one way to do that would be to expand the CRA so you pick up private equity companies and that are allowed to invest capital, or to expand it also to non-bank financial lenders and other types of institutions. But again, you can't do that without amending the statute. And the CRA does impose a lot of costs, both direct and indirect. I can't tell you the number of times the bank has been in a hard place for a merger or a branch expansion, and it's getting held up due to a CRA report. And it can cost a lot of money. If you're a large bank, it can cost millions of dollars to resolve those things. The last item is call report reform. This doesn't sound strictly consumer-oriented, but consumers are sometimes financial statement users. Certainly, consumer investors are. Activists and community groups that input into banking matters, they reference call reports. Call report requirements or instructions are overly complex and burdensome for community banks, and the requirements are adverse to systems integration and automation of data to populate the report. If you simplify and rationalize call reports, it would save a great deal of time and money and result in more meaningful call reports. You need to focus on safety and soundness, financial data that supports that, financial compliance, deposit insurance assessment, the financial data that supports CRA exams, as well as ensuring that call reports present relevant data to financial statement users. Call reports should not be used for collection of data unrelated to these prime purposes. All the schedules and data fields in a call report or attached to a call report need to be rationalized and organized. They could be organized along business lines, so where possible, banks can complete only the data fields and the corresponding schedules that correspond to the business lines offered by the bank. And that could greatly reduce the call report burden. Kind of rushed through that, but those are my opening comments. Thank you.
Thank you, Keith, and thank you all of the panelists for your opening comments. We will now move to the portion of the session, we can have a little bit more follow-up dialogue. And so I guess I would seed this by asking you can all have an opportunity to respond to this. We've got a diverse array of perspectives on this panel. So is there something that you've heard from another one of the panelists that you'd like to respond to? And like I said, I'll give everybody a chance, so in no particular order.
I could start. I believe Nikki's comments started with praising the Community Investment Act as an anti-redlining law, which of course we agree with. Unfortunately, there is a real limit to how much CRA currently under the 95 regulations and the current very discretionary approach to evaluating lending, for instance. 98% of banks are passing their CRA exams, and that's a very consistent 98%. Even as we've seen the banking industry retreat from mortgage lending, we still see 98% of banks passing their exams. In fact, from 2016 to 2023, there was at least 15 DOJ redlining settlements with banks. In 13 of those 15 instances, those banks were passing their CRA exams at the same time that DOJ was finding evidence of redlining, including at least one instance where the bank was actually getting an outstanding rating. Now, some of this, like for instance, what we've been able to work with Horatio to do in Illinois, would require a statutory change to better use race into CRA, as we've been able to work with Horatio to do in Illinois. However, I do think that the things in the 2023 rule that added much more transparency and just an understanding of the thresholds of performance that would merit satisfactory performance, I do think that those potentially could have addressed some of the lending issues that we've seen and would make the Community Investment Act better able to achieve its mission of ensuring that credit needs are all being met and addressing redlining. And also, without some of the reforms of the 2023 rule, you're steadily going to see Community Investment Act exams just count less and less and less and less because the bank branches are closing. Everyone knows that. A third of bank closures from 2017 to 2021 are in low to moderate income census tracts. So if you continue to hinge a CRA review on the presence of a bank branch, you are steadily going to evaluate less and less and less and less. That's why, and you can get into, I don't want to take all the time, but if you also, you go back, look at the legislative history of the Community Investment Act, its language was rejected that would have tied CRA more to, I think the term is primary rating area. That language was rejected because they wanted to convey that it's actually about entire community that they're chartered to serve. So that's why the regulators, we do believe would be on firm ground to defend against the industry lawsuit filed against the 2023 CRA rule. And I guess the only last point I'll make is, if you go back and you look at the comments from ABA, ICBA on the 2023 proposal, they're all supporting this idea of getting community development, outside of branch networks, and we also want more clarity on how to do that. However, you cannot let banks game this system by saying you can get credit anywhere in the country, but we will absolutely only look at your lending where you happen to maintain a branch. That is gaming the system.
Volunteer to go next.
Sure, just to respond to some of that. I think, first of all, when you look at the language of the CRA statute, it was written deliberately by Congress to be race neutral. So I think that explains just some of the tension there. It's really designed to focus on communities on the basis of low and moderate income and how well banks are serving low and moderate income people in their communities. Now, with regards to some of the more redlining specific things and the historical meaning of redlining, banks are subject to regular fair lending exams from their prudential regulators. I think a better use, or maybe a better topic of conversation here, is the extent to which some non-bank lenders are not examined as well for compliance with fair lending laws. I think in the previous administration, we saw the first ever federal redlining case brought against a credit union. There have been redlining cases against non-bank lenders, but because the regulatory burdens on banks has increased so much, that's what's caused a lot of the mortgage lending to shift out of the banking industry and into some of these less regulated sectors. And I think in terms of thinking about, regulatory parity, that's where regulation needs to catch up to ensure that lenders who are doing the activities that banks do or that banks used to do in some cases are regulated in the same way for fair lending compliance. Just really quickly, also, Horatio brought up this notion of inconsistency between examiners, and that is something that we've heard a lot about from our banks. And so I really agree with his suggestion for there to be more ongoing education of examiners, keeping them up to date with CRA rules, keeping them up to date with what examiners in other parts of the country are doing. I'm aware there's been some efforts at the Fed even to standardize performance evaluations between Federal Reserve banks. They often look different depending on what part of the country you're in. And so standardizing those is, I think, something that other prudential regulators can look to do. But there needs to be more examiner education. I heard, just as an anecdote from a bank the other day, their examiners were asking them, well, why haven't you put your public file online yet? Well, that's a requirement from the 2023 rule that is currently subject to litigation and is currently being proposed to be rescinded by the agencies. And so the examiners really, I guess, were not aware of that in that circumstance, and were asking them, the bank, why they weren't complying with a rule that's never going to be implemented. And so I think that's just evidence to me that more examiner education is needed.
If I could,
Actually, as a programming note, I'm trying to give everybody 3 minutes in this final segment. So if you can, to the extent you can eyeball it, that will give everybody equal airtime. So
Okay.
go right ahead. Thank you.
we have the official timer right there. So I think, unfortunately, the lack of effectiveness at the federal level is creating a more fragmented regulatory landscape. If you think about whether or not the current regulatory landscape for fair lending, redlining, the Community Reinvestment Act is actually solving the problem aimed to be resolved by Congress, I think we'd be hard-pressed to say probably not. It's not surprising for banks with satisfactory outstanding ratings to find themselves in court. We did, when I first came to Woodstock 5 years ago, we did an analysis of all of the fair lending lawsuits that ended up either in a judicial or regulatory penalty or finding. Over 70% of them came from nonprofits, not the regulatory agencies. And that gives the impression that you can fail your way to a satisfactory or an outstanding rating. And as such, then what that does is it empowers local communities through either a responsible banking ordinance like we had in the city of Chicago because of some of the data that we provided, or now a state CRA that covers credit unions and mortgage companies, because the feeling is that at the federal level, it's just not working. But now what you're going to have is a variety of different benchmarks. And when you're thinking about an overall ecosystem of paperwork, regulatory burden, it's becoming more fragmented because it's not working at the national level. So to a certain degree, maybe the solution is you make it so painfully fragmented that there's no choice but the industry to come here to Washington, D.C. and say, you got to figure something out because it's just too hard for us to be able to operate in this fragmented environment.
Thank you very much. Sorry, I didn't wait my one Mississippi. Victoria or Keith, would either of you like to weigh in next?
I don't need the whole 3 minutes. I've been listening to the conversation about redlining, evaluators not using same metrics. I think this is all relevant conversation that needs to be brought to the forefront because at the end of the day, it affects our low to medium, moderate communities. And what are we doing to make sure that funds are available? Funds are available for housing, funds are available for small businesses, and just making sure that it's fair and equitable. And a lot of times we don't see that being fair and equitable when it looks at various, certain communities. So I'm definitely listening and trying to really grasp the pros and the cons here. But I just want to make sure at the end of the day that we are really thinking about what's going to happen to our communities because a lot of our, I heard nonprofits brought up, a lot of us lost federal funding. And when you lose federal funding, now we're relying on the support from some of our CDFIs, some of our other banks in our community that help support the community and the work that we do. So I think, again, fair and equitable is really what we need to pay attention to and really focus on. Keith?
I'll come back again to the CRA as enacted in 1977. It says regulated financial institutions are required by law to demonstrate their deposit facilities serve the convenience and needs of the communities in which they are chartered to do business. The convenience and needs of the communities include the need for credit services as well as deposit services. I don't really see this as fair lending or redlining. I just see it as reinvesting in the community that your facilities are located in. And if you want to broaden the CRA, I think all those policies and proposals need to be in front of Congress. And also, I'll support the community banks as one of the other panelists said. Community bankers live where their customers live, and they're vested in the community. And if the community is not thriving, the bank's not thriving. Regional and larger banks, they do a lot for their communities too, but the leadership of the bank doesn't always live where the banks are doing, where their banks do business.
Thank you, Keith. We have 4 minutes left, timekeeper. If anyone would like some, 30-second sort of last words, please. Horatio made eye contact with me first, so.
Sure. Okay. That counts. There was a recurring theme throughout some of the other panels about size thresholds. And I know that financial institutions are put under a lot of scrutiny to know their customers, KYC. I'm not necessarily sure there's the same amount of expectation or responsibility for regulators to KYB, know your bank. There's an assumption that size means complexity and risk. And that's a false assumption to anybody that really knows the industry. So I think when you have central point of contacts at each agency with regard to the banks that they regulate, they need to actually be a central point of contact and know the bank well enough to understand what risks exist, how they're serving their community, the business model. Banking is a lot like restaurants. You can say you have $250,000 in revenue, but is it dine-in? Is it takeout? Is it Chinese food? Is it hamburger? Do you have synthetic froth gel on there, or is it just basically mac and cheese? They're all different. So knowing the bank is so important to be able to have a regulatory infrastructure that reduces burden but works.
Eye contact with me second.
Sure. So just going to this issue that Horatio raised earlier as well, which is about this sort of explosion of state-level CRAs that we've seen. That's a trend that I would really urge the federal regulators to monitor and to work with those state regulators in states where a state CRA has been passed or implemented. I think in some cases ICPA is somewhat supportive of those laws, supportive of credit unions and other non-banks being brought more into a regulatory treatment that looks more like what banks are subject to, and really requires them to invest in their communities in the same way. But I think the downside here, or the potential downside here, is does this create a very confusing sort of jumble of regulations where you have different standards as a bank at the state level and at the federal level, and so anything that can be done to coordinate between state and federal examiners in those states so that there's not that overlap or that it's as streamlined as possible, I think would be helpful.
2 minutes left, so this is truly the lightning round.
With the minimal time we have left, just want to reiterate that we've touched on a lot of complex and complicated issues today, but I think there are maybe not the lowest hanging fruit, but there are things that are very lighter lifts that I think the agency should really take a look at right now. Mentioned quickly in my remarks, but again, short on time. But I really think, really strongly consider issuing guidance to help CDFIs right now that are having lots of questions about delays in their certification through no fault of their own. Their activities have not changed. Like, look at what New York did. It's a very simple documentation. This would be immensely helpful for banks as well as CDFIs, and it's not a heavy lift. Also, I think further guidance on clarifying when exactly banks can receive credit outside of assessment areas. This is an issue that tremendously impacts many of our members working in rural areas, many of our members are native CDFIs. There are not bank mini bank branches or any bank branches in many of these communities. So please issue some guidance to clarify how credit can be received. There were some very helpful metrics in the 2023 rules that could potentially be used there. Yeah, I just wanted to reiterate that with my closing time.
I'd like to comment on the Know Your Bank comment. I endorse that. I think the best thing that could be done there is for the Federal Reserve, the OCC, and the FDIC to make sure they have competent leadership in the regional offices and in the 12 district banks for safety and soundness and compliance, and let them do their job. Those people are the closest to the banks, and I've seen too many times when layers of oversight in DC have just burgered up the whole thing. Have competent staff in the district banks and the regional offices, and let them do their job. They know their banks.
And we are at time, but Victoria, if you'd like to have one very brief last word, I will beg the indulgence of the timekeeper.
I yield. Thank you.
Thank you very much. Well, thank you to all of our panelists. This was extremely informative and interesting, and it's much appreciated that you came here to share your perspectives today. And I wanted to let everyone else in the room know that we are going to start the open comment session at 4:55. Thanks very much.